The moment everyone was told would never come has arrived quietly, almost deceptively, while most of the world was sleeping. Asian markets opened just hours ago, and instead of the collapse the banks desperately needed, silver did something far more dangerous. It held, it gapped up, and it refused to obey. On Friday, bullion banks unloaded billions of dollars in paper contracts in a last-ditch attempt to smash silver below the critical $65 level. That number wasn't random. It was psychological, mathematical, and existential for the short side of this trade. They needed fear before the weekend. They needed weakness before Asia opened. They needed momentum to die. None of that happened. When the bells rang in Tokyo and Sydney, silver didn't flinch. It opened strong above $67 and stayed there, sending a clear message: the suppression trade is breaking. This is not a normal price movement, and it is not bullish hype. A gap up at the open, after a coordinated smash, is the market's way of calling a bluff. What you're seeing on the chart right now may look calm, even boring, but that calm is deceptive. It's the kind of stillness you feel just before structural failure, when pressure has nowhere left to go. Behind the scenes, margin requirements are tightening, short positions are bleeding collateral by the minute, and the pricing mechanism itself is under stress. At the same time, this isn't just a paper story anymore. Industrial buyers are watching this open with alarm because they don't hedge silver, they consume it. When price rises while inventory is already thin, replacement risk becomes real. That's when off-market deals begin, vaults drain faster, and paper promises start to matter less than metal in hand. This video is not about predictions or hype cycles. It's about understanding why this Monday open changes everything, why the squeeze is no longer theoretical, and why what happens next won't be slow, linear, or orderly. The real move doesn't start with chaos, it starts with control quietly slipping away. The first phase of this event is unfolding entirely on the paper side of the market, and that is where most people are still looking, even though it is no longer where the real battle is being fought. Bullion banks and swap dealers entered last week with massive short positions, betting that silver could be forced back below key technical levels through sheer volume. On Friday, they fired what appears to have been a coordinated paper smash, dumping contracts into thin liquidity to trigger stops and break confidence. That strategy has worked for decades. But this time, something changed. When Asian markets opened, silver did not collapse. It gapped up and held, immediately pushing these short positions into lost territory. Every dollar above their average entry point is not just a loss on paper. It is a collateral problem. Margin requirements rise, liquidity tightens, and risk managers start making calls that traders do not want to receive. This is how squeezes actually begin, not with explosive candles, but with positions quietly becoming untenable. The market is now in a state of maximum pressure, where stability itself becomes dangerous for shorts because time works against them. The longer silver holds above this level, the more expensive it becomes to maintain the illusion of control. While the paper market is seizing up, the physical market is already sending warning signals that most investors never see in real time. Industrial users do not trade charts or momentum indicators. They operate on supply certainty. Companies like automakers, electronics manufacturers, and energy firms rely on steady silver deliveries to keep production lines running. When prices gap up while inventories are already tight, the issue is no longer cost, it is availability. This is where panic quietly begins. Reports are emerging of private, off-exchange deals between industrial buyers and miners, bypassing traditional pricing hubs entirely. These deals remove metal from a system before it ever reaches public vaults or exchanges. That creates a feedback loop. Less visible inventory leads to higher premiums, which leads to more off-market buying. At the same time, retail access begins to shrink as dealers pull inventory to protect themselves from replacement risk. This is why buying suddenly becomes temporarily unavailable during critical moves. It's not a technical issue, it's a survival mechanism. Once physical supply tightens enough, paper prices lose their authority, because contracts cannot deliver what no longer exists in sufficient quantity. The third driver of this squeeze is not located in New York or London, but thousands of miles away in Asia, where price discovery is becoming increasingly difficult to ignore. The Shanghai Gold Exchange has repeatedly shown higher prices for silver than Western markets, creating a persistent premium that acts like a vacuum. When silver is worth significantly more in Shanghai than in New York, metal flows east. This is basic economics, not conspiracy. Refiners, traders, and logistics firms respond to price signals, and right now those signals are screaming imbalance. Every ounce shipped east is an ounce removed from Western vaults, reducing available supply for delivery against paper contracts. This arbitrage gap is one of the most dangerous conditions for a leveraged market, because it exposes the difference between synthetic supply and real metal. As this gap widens, the cost of maintaining short positions rises exponentially. At a certain point, it becomes cheaper to exit at a loss than to defend the trade. That is when forced buying begins, and forced buying is what turns pressure into acceleration. This is how orderly markets become disorderly without warning. What comes next is not a straight line, and it will not be comfortable for anyone involved. The stability you see now is deceptive, because it exists only as long as confidence holds together. Once margin calls escalate, once physical shortages become undeniable, and once industrial buyers begin competing directly with investors, price stops responding to logic in the traditional sense. Moves become fast, gaps become common, and access becomes restricted. This is why squeezes feel sudden in hindsight, even though they build slowly in real time. The silver market is small, highly leveraged, and deeply interconnected with industrial demand. That combination makes it uniquely vulnerable to shocks. Whether this move pauses or accelerates, one thing has already changed. The market has shown that suppression is no longer guaranteed. Control has been challenged, and once that happens, the system does not return to its previous state. It adapts or it breaks.
Hello friend, welcome to my YouTube channel. I hope all if you are doing great and having an amazing day. My name is Noor Baqi and I am really excited to start this new journey with all if you. You know, this channel is not just about videos, it is about story and ideas and inspiration. I created this channel to sharing something positive every signal week. Sometimes we all need little motivation, and sometimes we just need a good story to smile again. Decide exactly what this channel is all about. You find understanding stories, real life experience, and powerful lessons that again change the way you think. I be uploading new videos regularly. So if you don't want to miss any of them, make sure to subscribe to my YouTube channel and press this bell icon so you get notification when you post something new. Your support means everything to me, and to great we can build a community full of partnership, learning, and good vibes. So sit back, relax, and let us begin this amazing journey together. Thank you so much for watching and welcome once again.